The 4-step method to high-performance trading and the 7-step daily routine for high-performance traders are both free downloads. The 4-step method for high-performance trading is about developing the mindset and the routines to increase your confidence and your ability to execute your trading edge in a live trading environment. Constant progress. 7-step daily routine for high-performance traders is an audio program download designed to help traders bulletproof their day-to-day habits, discipline, and develop a winning mindset. Again, the link is in the description box below. They're free downloads. Let's get started. Just reminding traders, if they're new to this channel or if this is the first time you've seen this video, if you go to this playlist, everything you need is in this playlist as it is titled. We go over the templates, the timings, the levels, the behavior of price. This will help to bulletproof your understanding of the best trade setups in the playbook. Again, these are free videos on the YouTube channel to support and enhance the skills and the development of your trading prowess within the playbook itself. Everything you need is in this playlist. Good day, traders. Stacey Burke from Stacey Burke Trading. We're going to continue our discussion from earlier today on when markets go out of balance. An out of balance market is when a market closes outside of a previous day's range, or at a market session open is outside of a previous day's range. For those of you familiar with market profile, Dalton, Mind Over Markets, the main focus is with market generated information to determine which instruments help us identify which instruments may offer us a best trade candidate on the day. We have signal days, we have first red day, first green day, we have inside days, we have breakout traders in the market. All traders have access to this market generated information. Yesterday's high of day, yesterday's low of day, yesterday's closing price, and the closing price of the week. And this can help us formulate a thesis each day for a best trade candidate based on this market generated information that we can use in hindsight. And when we have yesterday's high, yesterday's low, and the closing price of the week acts as a magnet as the new week starts the auction process. This is a fixed static reference point as the new week begins. The closing price is where value is determined, and the market will generate movement away from that area of value, and whether it's in the up direction or down direction, but that closing price area is where everything starts from in the new day or the new week. Now, typically, the most common day for a gap is on a Monday. We can see a gap on any day, on any given day, but typically Monday to Friday, we will see price open near or at the closing price level into the new day. Again, Monday is typically the most common day to see a gap form after the closing price of the week. But when we have our new day, our new trading session happening, this closing price, depending on where we're at in our Monday, Tuesday, Wednesday, Thursday, Friday, we could be in a pump and dump template over the course of a week. We could be in a dump and pump template over the course of the week. And closing price will have an important role in that. Typically, we can see, one of 3 or 4 types of templates. We can see a dump and pump template. As we just talked about, we can see a pump and dump template. This can occur over 3 days, 4 days, even 5 days. We can see a range-bound market template that sets up for a large move in either direction. And we can see a market that just breaks out and trends and trends and trends, and maybe into a new week will give us an opportunity. It could be a following week that gives us that reversal opportunity. We can see markets set up opening range, initial balance, and a dump and pump from a Tuesday, Wednesday, Thursday type template. There are different combinations, but today I want to just focus on recognizing opportunities on markets that close outside of the previous day's range. Very powerful, and as Paul Tudor Jones said, always think of your entry point as last night's close. And when you understand the importance of that and start to pay attention to that in the templates, this will really hit home with you. It's from Dalton's book, Mind Over Markets, Market Profile, page 88. talking about when markets go out of balance. The simple fact of whether a new day opens within or outside of the previous day's range helps a trader gauge two key time frame elements: trade risk and opportunity, number one, and number two, estimating or visualizing the day's potential range development. In short, the greatest risk and opportunity arise when a market opens outside of the previous day's range. This indicates that the market is out of balance. Now, this can occur at the close of a day, or it can occur at the open of a market session. For example, a market could break out in Asia and open in London outside of the previous day's range. Once it goes outside, other time frame traders enter into the picture and the market is out of balance and will either return to balance or potentially auction in a further direction outside of the range. I want to just go back and repeat. Monday is a new timing cycle in a new week, and Monday's opening range establishes the initial high and low for the new week. This is where we can generate a lot of our information based on how the market trades and how it closes. So I've talked about the matrix, the Fugazi. Day one, day two, Tuesday, that forms our initial balance. So what that means is that if they expand the range, now a lot of traders will call, sometimes initial balance will be a range expansion, and some traders will call it a failed breakout. So there's a difference between a range expansion for a continuation maybe on Free Cash Wednesday for the parabolic trade, or later in the week, because Tuesday now with that range expansion can form a high or low of the week, and we can get a Tuesday, Wednesday, Thursday trade, which comes back to 3-day setups from the playbook. 3-day setups build over 3 days. Now we still have a Monday, Tuesday, Wednesday, a Wednesday, Thursday, Friday template. I'll repeat that in every video because every new week is a new timing cycle. Monday's opening range, and by the time Tuesday is traded, we have our initial balance. That is our high and low for the week. And we can still have markets that break out for continuations. 3 days of breakout traders. Well, we're going to look at some examples today of the difference between a market that breaks out versus a market that forms a peak formation reversal and closes back inside of the range. So importance again of understanding closing price. So we can get breakout traders in the market. We can get first red day, first green day, inside day, false break, and trend trades. So I repeated earlier today about making sure that you don't just call every up day a first green day and every down day a first red day. Understand the type of template that you're in. And hopefully today that will clarify that because, again, understanding where closing price is and who is trapped in the markets and the type of template that sets up on the day. Now we're looking at the Japanese yen. I'm going to run through a few different templates, and I want traders to grasp the concept of when markets are out of balance or in balance. And today, this particular template will hopefully really resonate with some traders. If we look at the Japanese yen, this is a 1 hour chart. Time frame is irrelevant. Doesn't matter what session you're trading in. It's understanding whether or not you have an opportunity for a best trade candidate on the day. So when we come into our closing range of the week on Friday, the market closes at the extreme of the previous Thursday's range on the Friday. And that is our new closing price for the week. Now, we'll go more in depth into weekly levels in a future video, but today I want to talk about out of balance markets. We have a market that on Monday breaks out, and this is an example of where I have repeated to traders, don't counter trend to day one runner. Day one runner breaks out and stays outside. There's no best trade candidate reversal. We have a 3-day setup in this Thursday, Friday, Monday template. It's in balance when the market opens on Monday. So the closing price on Friday is inside of on Monday morning, the weekly closing price is inside of Friday's range. It stayed in balance at the extreme of Thursday's low of day, but it closes out of balance,
meaning outside of the previous day's range. And as Dalton said, this market may provide us with an opportunity when it's out of balance, because other time frame traders will now be entering into the market to either reverse that on Tuesday or in Asia or Asia, London, New York, whatever that may be, or they may continue for a range expansion on day 2, where the market continues to trade in the direction of that breakout. It stays out of balance on Tuesday, day 2. So we've closed further away. Day 1, day 2, days of breakout traders in the market, and that continues on day 3. So we have a market that's out of balance on both Monday's close, Tuesday's close, and now on Wednesday's close for 3 days of breakout traders in the markets. This is where it gets interesting. We have a market that's out of balance on day 3, and this is where traders will look for, we've got 3 days of breakout traders in the market, and where I work from is at the extreme. So we have no opportunity on the Thursday for a reversal trade on 3 days of breakout traders. We have an inside day. It's a signal day. But on Free Cash Friday, traders in the Europe-London window had the reversal trade opportunity from the high of the week to the low of the day. But you'll notice on Thursday, from Wednesday's closing price and Thursday's closing price are identical. They have closed back in balance on Thursday. And heading into our new week, Friday's closing price is also in range. You'll notice that the closing price for the previous 3 days is almost identical. Now, I want you to realize that closing price is our reference point each day when the market begins to auction. Now, on Friday, the market broke out and reversed. It broke out and reversed, and on Monday, closing price is our magnet, our reference point for that auction process as the new week begins. This price heading into the new week is what the market references. High and low of the previous day are levels, but when the market opens on Monday morning, that price is where it closed, and that is the reference point heading into the new week. And that can give traders an opportunity, if indeed it presents, for recognizing we have breakout traders in the markets at the high of the week and the high of the day on Friday. And the market gives traders an opportunity in Asia off closing price. Where is the money? But it comes back at the end of the day on Monday and closes at the same level. Closing price has remained at that same level now for 1, 2, 3, 4 days. But in the process, in our new week, we have our opening range on Monday. Market's in balance. It breaks out on day 2, making our initial balance, our range expansion, higher high and a lower low. Higher high and a lower low. But on Tuesday, the market closes outside of the previous day's range. We now have a market that is out of balance. As we saw on the previous Monday, it closed out of balance, and on Tuesday gave traders the continuation trade long, whereas on Wednesday this week, we have the reversal trade starting in the Asian session, and we'll just use the reference point of Wednesday's closing prices. They're pretty much all the same all the way across. The market breaks through that level, pulls back at the open of our Asian session window to continue that move down. Now we have a market where breakout traders are in the market at the close of the session from the U.S. window. Where is the money? Now this is an example of where the range expansion on day 2 becomes our new low of the week. We have our high of the week. They expanded the range early in the Asian session. They triggered breakouts on day 2, went down, stopped out traders who were long, triggered breakouts for shorts, pulled it back, and went back up to the high of the day before breaking down in the Asian session on Free Cash Wednesday for a parabolic opportunity in the U.S. window for a low-hanging fruit continuation trade before pulling back and closing back in balance. So we're back inside of the previous day's range. We'll look at this trade in a moment. But understanding that closing price closed outside of our opening range, outside of the previous day's range. We have breakout traders in the market. That market broke down. So coming into the U.S. window now, we have the potential for the low-hanging fruit trade going after the money. Now, this is also an example of where traders will say they waited till 9:30, but we already have a trade that's underway. We have a trade that's underway, and this is an example of where the market can. This is a London session trade. So London traders are already in the market. We have our universal entry criteria already met. This is a continuation low-hanging fruit trade. If traders were to come to the screen just prior to the open, there's no major red news until 9:45. This is an example of where the market will accelerate potentially into the move, and the New York Open is the reversal at the low of the day. You'll recognize again, we've broken outside of the previous day's range, and the New York Open now, the open of the New York session, the equity market open, is outside of the range and out of balance. Now we have major red news that was the catalyst for this gap. But in a normal circumstance, this is an example of where the market was out of balance and returned to balance. It auctioned back into that peak formation low made at the New York Open on the gap of major red news before reversing. Low of day level is our entry target, meaning that once you have the thesis that this is locked in place, we have our little peak formation, and then our micro W, we want to get filled below or better than the low of day level for the reversal trade if you were trading this later in the session. The original trade is the existing short trade. Timings, currencies can move because this is an already existing move underway from the low of day of London for the continuation trade into the New York Open for the explosive reversal on major red news after the market has gone out of balance. Explosion, that's our break in structure on the major red news. The auction dump down into the peak formation made at the low of the day for the reversal trade back into the balance area. Now we're looking at the Canadian dollar. We have a market that will just back this up and look at our previous week's template, our closing range of the week, Wednesday, Thursday, Friday. The market broke out on Friday, making this market out of balance heading into our new week, meaning that it broke out and it closed. It closed outside of the range, out of balance. Market on Monday closed in balance. It closed in balance, and that means it closed inside of the previous day's range. So we were out of balance on Friday's close. Market traded down. We had our opening range initial balance on our Monday. Just move this line up. And opening range is our Asia session range, and then our London session. We redraw those levels if there's a range expansion. That is our box heading into our New York session on day one of a new timing cycle in a market that's out of balance. That market gave us a reversal trade. So we have our New York session opening, the U.S. session opening out of balance, pulling back inside. We had our higher highs for the dump and pump template reversing. So remember, we have an out of balance market that gave us a reversal template. It closed back in range and then continued to make a higher high initially, a range expansion on day two, our initial balance, and closed with higher highs, but closed in balance, meaning it closed inside of the previous day's range. On day three, we have a market that now auctions below closing price. First goes above, that's our higher high on the inside, before dumping down and breaking outside of the range. Asia session high, we make a lower low in our London window. That forms our box on day three, and we're now out of balance. We are now out of balance. We're outside of the previous day's range, and we're back inside of the U.S. session box down at the closing price of the week. So remember, that closing price of the week is our magnet. And if you don't understand what that means, assume that you sold this price. You sold this. They're not letting you out with any profit. Okay, so we want to be buyers at that level when the template gives us a dump and pump type template. More importantly, though, we have one level down, two level down, and three levels down into our New York session open. We had a major red news catalyst that catapulted this, a first minute opportunity on a short squeeze template and a dump and pump larger time frame template on day 3. Now, market closed in balance, but auctioned back down into our level 1. So some traders have asked, what do you mean by level 1? I'm going to suggest that it's very straightforward in that this first consolidation is our level 1. That market proceeded up to form our middle consolidation, that's level 2. They dumped it back down into our level 1 for the explosive blow off on day 3 to a level 3. Now the market closed out of balance on day 3 up top. Market broke out immediately and reversed before pushing back into closing price at our Europe-London window and auctioning down, breaking down into a creeping trend. So New York session is back in balance when it opened. Our opportunities may not have been as good or more limited because we now have a breakout pullback type template. We're trading back down into the breakout. We'll look at an example of the Euro pairs where they were trading inside of a consolidation for a collapse back to the low of the day. So we have breakout traders in the market. They've come back into those breakout traders, auctioned back into the U.S. session continuation. But a market that is in breakout now is potential for a large ranging day or a reversal opportunity. In this particular case, we did not get that on day 1, day 2, day 3, but we had a larger template setting up and a short squeeze template setting up on day 3 for the parabolic explosive move. And just repeating that when you understand that breakout traders are in the markets, we have higher lows on day 2, those breakout traders have now been stopped out and the market is out of balance, our opening range initial balance, and consolidating at the New York Open. This first minute that reverses, this is a 15-minute chart, but this first minute confirms our thesis for the first bar entry back in line with the short squeeze template. Breakout traders have already been stopped out. We now have breakout traders on the short side who are now the target for the reversal trade. Now, I want to just sort of emphasize to people the importance of understanding this because it will help you identify the signal days much clearer and the type of opportunity on an instrument, whether it's a high quality opportunity or if there's a better instrument. So when I show these templates, there may be other templates on the day on other instruments that were better setups, but being able to read whether or not a market is setting up properly for either a trend trade or a reversal trade and a parabolic setup. So differentiating between taking trades versus identifying a coil for an explosive move where it's easy, free cash. Now we're looking at the Swiss franc. Previous Monday closed out of balance, similar to our Japanese yen. So we have day 1 breakout traders. So just take a look at any other given day. For example, if we look at the previous Thursday, breakout that reverses. And on the Monday, we see a breakout that stays. And then we see a continuation on day 2, Tuesday, day 2, front side, day 1, day 2, day 3. Day 3 breakout traders in the markets. Day 3 breakout traders in the market, and the market is out of balance still. So closing outside of the previous day's range. Now, the following Thursday, the market closes within Wednesday's range. So now we're back in balance. Back in balance meaning that there may not be a high probability opportunity or as good of opportunity on a day where the market closes outside of the previous day's range. There's more volatility because there's uncertainty and the market is trying to establish where that value is. Now, interestingly enough, similar to our Japanese yen, again, the green level is our closing price. The market trades in balance until our new week. So we have Wednesday, Thursday, Thursday's in balance, Friday closing price of the week, and the highest closing price of the week. Very important to recognize when you have the highest or lowest closing price of the week. We trade Monday, Tuesday, so our process is the same. Monday establishes the new high and low for a new week, a new timing cycle. We also broke weekly high levels on this pair. We broke the high of the week. We broke the low of the week first. Now understand this. Think about this. Trigger breakouts on the downside first, a lower low on the inside before reversing and taking out the high of the day, the high of the week, and closing out of balance, closing outside of the range. That breaks down immediately in the Asian session the new day. And for the hindsiders out there who don't like that, remember I'm coming to the screen for the U.S. session. But this is an opportunity of where Asian session traders may have looked to position themselves in with a starter early. Europe, London, major red news, I believe, on this day on the euro. But the U.S. session is where, as we saw in the Japanese yen, the low-hanging fruit opportunity. Trigger breakouts on the downside first, so expand the range on the downside, expand the range on the upside, hit the stops, clear out the weekly levels, break down, go into consolidation, peak formation low, peak formation high. I didn't mention this for the Japanese yen, but we'll do it for this pair. That's our day zero setup. Not only did we trigger the wrong side first, so they get people chasing the move on the wrong side first before reversing the market on day two, but they clear out the weekly levels. That's our day zero setup and the consolidation that breaks through the highest closing price of the week for the collapse, the vertical collapse after major red news in the Europe session, and the low-hanging fruit continuation trade in the U.S. window. That market closed out of balance, gain outside of the previous day's range. We have breakout traders in the market before pulling back inside. So remember, if you were short on a longer time frame, even in our U.S. window, we have our U.S. session highs above this level. Okay, if you were short at the closing price level on longer time frames, they are not letting you have any sniff of any profits. So recognize that when it shows up, when closing price goes out of balance. Again, similar to what we saw up top, but we got a whole U.S. session trapped down low as we trade in our London window for the beginning of the explosive reversal. Reversal in London, the pullback to that level, the breakout level, and then our U.S. session continuation in the New York session. When we come to the screen in our New York window, we had major red news. Pin is a snowplow and a target for a 25 pip reversal in the New York Open after major red news. Market that was out of balance. We'll zoom this back out. Broke out and went out of balance at the close of the day after major New York session, major red news reversal. So again, just recognizing when they reverse, going to close, and they're not letting anybody who is in the market down low be in the money for very long, if at all. So we have market, and we just go to the high of the U.S. window. They go up right away and get those traders who are long. They go back down and get traders who are, short, get those traders who are long in the Asian window before reversing off closing price levels, little micro W, peak formation, consolidation, same process applies, consolidation for the expansion, the higher high, and the dump and pump template in the U.S. window. Market that closed out of balance. We're looking at the euro yen, and this is a fantastic example of recognizing where a market appears to have closed in balance on Thursday. And if we go back to our template, opening range, initial balance, day 2. So we have a range expansion on day 2, but also a failed breakout because the other side of the range was hit. So clarifying again that I do not start a new 3-day count for a 3-day setup unless the opposite side of a daily level is broken. So you can have a failed breakout, but it doesn't start a new count until the opposite side of the range is broken. So we have our opening range. We have our initial balance, which is an expansion of the range, and then we have day 1 breakout traders in the market. Our closing price, though, is still in balance. So we have breakout pullback. It's still inside of Monday's opening range. Market breaks down again on Wednesday. We have day 2 breakout traders. We have, as Paul Tudor Jones says, if the market is giving you an indication of a range expansion, don't fight that direction. So we've tapped the bottom on day 1, tapped the bottom on day 2 trigger breakouts, but we've clearly broken out on Tuesday, and then broken out again on Wednesday, and that closed outside of our opening range. So that's an opening range breakout. We're outside of the opening range. Recognize where all the 2 previous days broke out and pulled back inside, but we have a lower low on the downside. Now, what type of template sets up on the day? This is where I really like to get specific, because we won't look at all the euro pairs. There was major red news, but that was at 8.15, and then an 8.30 US dollar catalyst, which, again, sometimes a great question from a trader was, I want to look at other pairs other than US dollar crosses if there's US major red news. So I just use the euro pound Aussie, euro pound yen, euro pound Canadian. And the same process applies now. We have our closing price. We have a market that's pumping up from closing price, opening range, and initial balance. Now, an excellent question again today from a trader was, why didn't I mark my high at the high of the London session? And the reason for that is that we had a breakout that failed. So this is an example of where the thesis is that London has put in the high of the day. So traders will be looking for a 3-level setup where we pump back up and make 3 higher highs coming out of level 1. But the market broke out, pulled back inside, and we are underneath Monday's opening range. So we're in breakout now, and the market is setting up with a nice head and shoulders reversal pattern. Now, the key to making sure that this is correct is, of course, waiting for major red news. And so once major red news prints at 8.30, we had 8.15 euro rate announcement, and then 8.30 unemployment advanced GDP. We had an engulfment rate at 8.30. And so when the news hits, we get a spike back up. This is a 5-minute chart. 15-minute chart, but we'll go down to our 5-minute chart. When our 5-minute chart closes, we are clearly inside of our coil. We've got a little micro M structure on a shorter time frame. What that means is we've got our little M double top, our middle structure right at our opening range, and then the engulfment inside right at the close of the 5 minutes after the news, for a parabolic reversal trade back down to the low of the week. A range expansion possibility. It cleared out the low of the week. When we take out the higher low of a week, those levels are paramount over everything else. But recognizing even on a larger template now how closing price broke outside of our opening range. Now, gold was a great opportunity today for traders in both directions after the news and then after it made its peak formation high into the 3rd hour. Same process applies. I'm going to go back and talk about my thesis on this week in general. In a later video, we'll also talk about these tails in the opening range, how they can be powerful information for recognizing when we're going to get a nice template. Coming back to last Wednesday, the midpoint range of the week, we had a failed breakout on Free Cash Friday. That market actually closed out of balance on Friday heading into our new week. That was our closing price. So it broke out of Thursday's range. It failed at Wednesday's high. So we have a market now that has closed out of balance, and we had breakout traders in the markets. That's our highest closing price heading into the close of the week. And there's a couple things that traders can use as information. Remember, we have breakout traders in the market. The first place the market goes after off a closing price is the low of the day on the opposite side. So breakout traders long, they go after the low of the day. They pump it back up to closing price into our New York window. No major red news on the schedule for the collapse back down before pulling it back inside of Friday's range. So we have a market that has now closed in balance. It was out of balance on Friday. It closes in balance, goes into consolidation before going parabolic. And as I mentioned to one trader, looking at this, calling it a first red day on a Monday, this creeping trend into the close and then it closing in balance, that's a short squeeze opportunity heading into our Asia window. What's important is how does price set up on the day in the template when we get our opportunity like this. So you can have the thesis, but if it breaks down right away, well, the short squeeze is invalid. Remember, they're not going to let anybody out of the market if they're in the money and they're short at the close of the day. The first place they're going to go is in the opposite direction, and they're not going to give anybody a chance to grab any profits. Market trades back up to this level again where it failed. So what that means is when it traded up there last time, it reversed right away. Anything above that level, it reversed. So it seems that when it breaks into this area above previous day's high and goes out of balance, there is selling going on at that level. Now we can project that large death candle across from our left of our screen because hindsight pays. This large death candle seems to be an area we're selling every time we go up there. They step in and hit the sell off. So we had day one, day two, closing price down low. We have highest closing price of the week. We get a market that now trades on both sides of our closing price, pumping it up into that level into our New York session open, major red news catalyst. And again, remember, I'm going to show this in a moment. At 9:30, we are already on the reversal. Major red news at 9:45 for the collapse and a range expansion opportunity on the downside. This market closed out of balance today, closed outside of our opening range and outside of the previous day's range. Third hour trade opportunity on Wednesday after the news. And where does the market pump up to after the news candle? Right back up to that level. 1 hour, 2 hour, third hour reversal back to closing price. And again, you'll notice breakout traders that were in the market or traders that are short at the low of the day, they wick through that super fast unless somebody had a limit order. They're still holding on to that trade. The market does not let them get any profits. On Wednesday, we already have a market that at the New York Open is parabolic and going short. We had a major red news and a gap. If traders waited for this to go into consolidation, the beginning of the third hour gave traders a perfect opportunity to re-enter this on first bounce. Again, this is a 5-minute chart now for the collapse down through the low of the day and a measured move range expansion opportunity. Now, when a market goes vertical on news, you've heard me say this, the pins will become targets or boundaries, and that forms our box, our redrawn expansion, now our range expansion as we head into the second hour, 1 hour, 2 hours, and a third hour reversal. We have 1 hour bull candle, 2 hour bull candle, and the third hour is reversing on the 5-minute time frame for the trade back down to closing price level on a market that closed out of balance. So it's outside of the range. It closes outside of the previous day's range, outside of the opening range, and that market goes vertical, pushing back up to traders who were short third hour after major red news on Wednesday. So again, understanding where the bulk of traders have gotten into the market, they've been stopped out. Now they trade back down into into longs. And you'll notice whenever there's a wick, if we go back to our 5-minute chart here, understand that this is the best price they're getting filled at if they're on the 5-minute time frame. The market is going to go through at least the opening price back to closing price level to put heat into traders who are long, who didn't lock in any money or take any profits. West Texas, we'll go over a couple more real quickly. West Texas closed out of balance on Monday, opening range. So we have our initial high-low for the new week. It closes right at the extreme border of Friday, which was the high of the week. It's out of balance on the verge of being out of balance before trading on both sides of the closing price. That establishes our opening range and initial balance, and that gave a vertical breakout right at the U.S. session second hour for the explosive reversal back up to the high of the day, closing pretty much in the same spot that it opened. And again, you'll notice the closing price of the week from Friday right here. We'll just map that out. That acted as a basement on day 2. We had a breakout, a range expansion. We have shorts triggered in the market before going vertical and closing out of balance. They auction back down into closing price of the week. That's our reference point before going vertical, pulling back into that peak formation low, consolidating higher highs, again auctioning on both sides of closing price, dumping down into our peak formation low, going vertical, higher high before major red news, 9:45, and then the entry, third hour for the continuation long. Again, the same thing applies, but you'll notice on Wednesday we close out of balance. So I'm going to reinforce this. Hindsight pays. If you understand the setups and what an out of balance market tells us, then you'll recognize that hindsight pays. We're making higher highs on a day that closed out of balance. This is not a false break. Asia, level 1. London, level 2. The dump and pump at the high of day level beginning of the U.S. session for the continuation long trade on a range expansion opportunity in a market that is in breakout on Thursday. So closing price closed out of balance. The market continued to auction higher, breaking out again, dumping down, and opening in the U.S. window out of balance at the level for the range expansion continuation trade in the New York window. And lastly, DJ30. This market demonstrated, I think, the best out of the indexes today in terms of recognizable opportunity. Obviously, there were buys and sells, but in terms of seeing a market that's out of balance and identifying a potential setup, number one, on Monday, we have markets that are already out of balance heading into the session. On all markets, we talked about this trade on Monday. This was an excellent trade for a range expansion right at the open from the high of the day. Breakout on day 1 that closes out of balance. Obviously, we're already out of balance. It's out of balance. And there's our opening range on Monday. Initial high low for the week. We have breakout traders in the market, and that market consolidates sideways. Again, remembering not letting anybody have any profits if they were long at the closing price before breaking down and taking out the low of the week on day 2. We have a range expansion on the downside. Range expansion on the downside. That market pulls back inside and closes in balance, but we have a lower low on the inside, which is a potential setup for pump and dump. Pump and dump template. So the market trades up and goes parabolic into our U.S. window before reversing later in the session. So we had the initial collapse back to closing price. We'll zoom in here so traders can see that. Pin hammer right at 9:30. 100 pip box back down to the closing price level. So we've auctioned up, we've engulfed. 9:30 takes out the high of the day. And when a market's going level 1, level 2, just draw this in here real quick. Level 1, then we get our level 2 heading into our U.S. window. This is a 75 pip range that this market has taken out here. So this is a good parabolic long pre-market. The market consolidates at the high of the day before reversing, and that establishes the high of the day. The market then proceeds to put in a low of the day. So as Dalton talks about, it can take 60 to 90 minutes to establish a high-low once that market opens. So we have our peak formation high, peak formation low, 1 push, 2 push, 3 pushes, a later session shorting opportunity on Wednesday. So initial scalping trade, 100 pips back to closing price. Once the market broke outside, so again, it broke outside and opened out of balance up top and reversed back to closing price. Closed in balance. But what it did do today was it broke outside as the U.S. window began. We had major red news at 8:30. And as several traders took advantage of that pin hammer on the news catalyst, remember first bar news catalyst momentum trade, thesis being that we're now targeting back into traders, if we just zoom back here, into traders that were short. This is a 15-minute chart. If we go to our 5-minute chart and look at the trade on Wednesday at the high of the session, our little engulfment candle, you'll notice that the news catalyst opportunity took traders up into the New York Open, level 1, level 2, and then 1, 2, 3, third hour reversal back through closing price into breakout traders. So the market went out of balance just prior to major red news. That's our opening range initial balance. Our U.S. session window opens up outside of that range, pulling back inside. This is a 5-minute chart now, and a news catalyst opportunity targeting not only the high of the day, but the continuation trade back up into shorts from our U.S. session trade later on Wednesday, and then a third hour reversal back into breakout traders. So fantastic opportunities, but recognizing once a market breaks out, whether it's at the close of the day or the open of a session, when the market session opens, if it's out of balance, that can create potential large opportunities for traders on the day. There were several other good templates. Without dragging this video on further, we'll probably look at a few other ones in next couple days. Understand the importance of when a market goes out of balance. Timings, levels, behavior of price. 3 levels that are constant and static. If we go back and just look at some simple stuff, if we get rid of everything on this chart and just go back to basic charts, recognizing when the week opens, we have an auction process that starts to move away. This is our reference point. When the week opens, this is what the market sees the value level at until it establishes a new value level. It moved away from that value level, it came back to it. It moved away from that value level, triggered breakouts, hit stops, it came back to it. It auctioned around it, both sides of it, traded off of it. Closing price of the week, closing price of the day, recognize when the market goes out of balance. That can offer you huge potential opportunities. We have markets that trade all over the place, and the closing price really doesn't change a whole lot. When you understand that, you'll understand where the Fugazi is, and you won't get stuck chasing movement or taking trades. You'll be focused on parabolic opportunities when they present. Keep it simple, traders. Day 1, day 2, day 3, timings, levels, behavior of price. Have a great day, and may the markets go with you.